Bloomberg Audio Studios. Podcasts, radio, news.
There's no one better to talk to than Michael Roberts, CEO of HSBC, a bank, and CEO of the Corporate and Institutional Bank at the region. I'm just curious, given the fact that HSBC, and welcome, is such a central bank in both trade as well as in both China and in the West,
right.
How significant do you see this latest eruption of trade tensions between the U.S. and China? Does this feel different?
Yeah, no, first of all, thank you for having me today. Look, I think the world has gotten used to a lot of these tariff changes, although certainly this newest round is yet another bit of unpredictability. I think companies have been now looking for different ways to manage their supply chains. We have a survey that we did right after Liberation Day, which I think still holds true today. We surveyed 5,000 clients, so big survey, and they all said, one, all of these tariffs are going to cause a lot of issues. Prices will go up. Two, most of them now are looking at their supply chains. And the word, I think, supply chain has now come to be one of probably the most discussed terms in any C-suite today. And thirdly, they're going to change, and they may even change business models. So this next round, this current round, I think just tells you that they're going to have to significantly change what that is, because 100% tariffs, you can't absorb 100% tariffs. So that means there'll be a greater acceleration to where those new supply chains will be. However, it has been a bit of a whack-a-mole because you have to constantly look at where the next tariffs will come from. And that's been a challenge to many companies. They really have to figure out what is the least vulnerable place they can be or the most tariff-proof place they can be, and how do they then export into the U.S. or frankly anywhere to make sure that they can do so as effectively as possible.
How much of the extra costs from tariffs been realized? And not just tariffs, but also the rejiggering of supply chains.
Yeah, so rule of thumb, when I talk to most people, probably 70-80% is borne by the producer versus the importer. The last 20% now is starting to seep into end buyer, the customer. I think most are saying we can't continue to absorb that much additional cost as the importer or the distributor. Therefore, it will start shifting more and more to the end buyer, the client or the customer. So that there's been I think a strong effort, however, to try to absorb as much as possible. So I talked to a retailer, a high fashion retailer, saying me and the distributor or the producer out of Asia and me as the distributor are absorbing as much as we possibly can. We understand we could do that, but it will come to an end soon.
John and Anne-Marie were talking to Fed Governor Chris Waller and about the balance between inflation and the labor market. And there's this feeling that any kind of inflation is going to be short-lived and the effect on the labor market could potentially be pernicious. Are you seeing that companies, instead of raising prices, laying off workers or trying to revert to artificial intelligence to bridge the gaps?
Not yet. However, there's a lot of cost pressures. I think there's a delay, a lot of investment. I mean, that's the flip side of that, because I do think people want predictability. The companies need to understand where they're going to put down a lot of capital, that capital is going to produce good returns because of more predictability. I've seen slowing of hiring, but not real firing today. And so that's kind of, again, the flip side of that coin. But really, it's the capital and the investments that you're starting to see slow down quite a lot.
Meanwhile, we've heard a lot here at the meetings in Washington, D.C. about a number of themes, AI, which we'll get to in a second, but also this question around credit froth and an AI-related bubble. How much are you getting concerned, akin to what J.P. Morgan's been talking about, of a real turn in the credit cycle or some sort of later innings that give you pause and make you more cautious? Yeah,
look, I do think this is not the first instance of what is inventory financing fraud, which is essentially selling, or using the same bit of inventory to finance multiple times. We've seen that in Europe a couple times as well in the last, say, 9 months. So I am more concerned, and something that we're very focused on. So, in fact, we're using technology we developed in our trade business and using that throughout all of our lending platforms now to try to go through and be very specific that everything we finance is good collateral. It doesn't have multiple liens on top of it, which is really what happened at First Brands. It's tough to do, and I think, the fraudsters are getting better at it. So we're going to have to respond to being much better on due diligence. We were not involved, obviously, directly in First Brands, so don't know how much due diligence was done, but I think these type of financing arrangements are going to require much more due diligence, much greater technology, much more specific understanding of exactly what you're financing.
The other aspect has been just sort of how much AI has actually boosted productivity, boosted profitability versus been a real cost center for the most part. Ken Griffin came out of Citadel saying that he's not seeing evidence that AI programs can really make an edge in financial markets. I know that HSBC has been big in quantum computing and has this test. Are you seeing real gains? Are you actually deploying quantitative strategies from quantitative computing on your trading floors?
Yeah, so just for those who don't know, we had a partnership, still do, with IBM. We developed quantum computing really for financial markets, focusing on the bond market. And we used both quantum computing and more traditional computing, brought them together, changed the way we looked at data. There's this thing called representation data that we actually flipped into a more of a quantum computing type of mode. That led to a 34% improvement in our ability to predict a trade. So if you were going to make a trade, we get to understand that trade 34% better to see the matching between buyer and seller is really what it comes down to. So that was very effective. It's an initial study. We did, however, test it on multiple quantum computing machines. We did all the statistical analysis. So we really do think there's something there. It can be used for any traded asset, so any asset class. I think the power that brings is going to give an edge. I don't know how it wouldn't give an edge, but I think it'll be, once we roll it out and others roll it out, there'll be quick adoption by, I think, the industry. I mean, it's the same industry that tries to reduce latency to its, smallest possible amount. So I do think technology does bring a substantial edge.
Do you think it's going to replace traders?
That I don't know. I mean, I think there'll always be humans involved, but I think it'll help traders quite a lot. And I think it'll change really the way traders think about it, because when you have that much compute power and you could really use it, I think today, we use a lot AI, as you said, through algorithmic trading. This will just be one more substantial boost to the power of algorithmic trading that we see today. So will there be less traders? Don't know, but are they going to have powerful machines? Definitely so.
The other theme here, and this is something that comes up in pretty much every conversation, is the debasement of the dollar. Yeah. And this question of how much the dollar is losing its heft as a reserve currency. Yeah. Internationally, do you see any signs that people truly are moving away from the greenback? Yeah, it's a great question. So I happen to be traveling to Asia right after Liberation Day, and I would say that was probably the number one conversation that I was having by very big, very sophisticated, large holders of dollars. And they were quite focused on this idea of de-dollarization, or debasement of the dollar as a reserve currency. And the mere fact that they're talking about it in the terms they were tells you something is different. Now, if you look at where the dollar is today, trade flows, reserves, the primary currency of invoicing for most commercial flows, the markets flows, it's all well north of 50%. It's 60, 70, 80% in all those various metrics. It will take a long time to find another reserve currency. And the other biggest question is, if you're going to go away from dollars, what are you going to do, and what will be that reserve currency that replaces it? There is no other alternative today. And so that's the twin issues that you have, the conundrum. Maybe go away from dollars, but what are we going to go to instead? To wrap it all up, there is this feeling that the center of finance has shifted. Mm-hmm. And it's not so clearly in the United States. And It's something that you've been focusing a lot. How do you see the sort of tentacles of finance in terms of where they are flowing from, transforming really over the past couple of years? Yeah, no, I think there's significant transformation going on. And if you think there was a unipolar world with the U.S. right in the middle of it, still is, and the U.S. capital market is the most liquid of the world, still the dominant place to trade. However, you need to look at where trade and commercial flows are going, where financial flows are going. I would look between the Middle East and Asia as an example. Substantial increase of flows between those two regions, and they're not flows that are necessarily coming from the West, just being transshipped through those regions. They're actually wealth that is being rechanneled in that region itself. I think you'll see that more and more. I think you'll see Asia, Middle East coming together more and more, and I think you'll have a much more balanced equation. I don't think there'll be as a dominant, source of financial flows that you've seen before. And great for us because we have to be very strong in those two regions. But I do think people need to understand that there's a significant change going on. And those flows will not just go through New York as they used to in the past. Michael Roberts, thank you so much for taking the time. Really wonderful to speak with you. And John, that was Michael Roberts of HSBC on some of the key topics here and the idea of how much that financial center has shifted.